Okay, folks, welcome back. This is the Monday afternoon teaching that I promised you guys I would give you for technically last week, but it's just being an extra video. And I'll do my normal Wednesday and weekend review this week, so you'll still have 2 more videos for this particular week. All right, so we have the dollar index as our daily chart. We have exactly what we were hoping to see today. We had the market open, trade down, make its low initially, and then big run up. Now we're taking out this short-term high and we're targeting this old high here. So we'll be looking for a run above 93.32 and looking for some expansion above that. We want to see speed again, as I mentioned on Saturday. I don't want to see a shallow little run above this high. I really want to see it have a meaningful run above, and then once it clears it, I really want to see large ranges come in. I don't want to see a very lethargic, like I mentioned on Saturday, just peaking above, and then that would indicate to me that it wants to go back down into the range, and then it's problematic for the bulls. But I said that we would have the run higher on dollar. That was the best case scenario, and I wanted to see the mirror image of that in gold. Okay, so I want to jump over to that first. This is gold, and I'll show the daily chart in a moment. About 38 minutes into Saturday's video, if you go at the 38-minute mark, you'll hear me talk about gold and how it should want to reach down into its fair value gap on the daily chart and all that. So what I'm showing here is a 15-minute time frame. If you were all watching on Twitter today, I kind of pointed, let you know that we had traded into a fair value gap without saying so, obviously, because I don't want to teach via mentorship. But today was a needed thing today. There's a lot of tomfoolery going on Twitter. So what we have here is the 15-minute time frame. This is the beginning of the New York session. So we want to see what price is done after that. So we see a displacement lower with the long-term bias I gave you on Saturday, which was bullish dollar, bearish gold. So it creates an imbalance here, okay, from this candle's low up to this candle's high. That was the remaining fair value gap. Initially it was here at this candle's high, and then it went a little bit higher, leaving that small portion in here. This candle went slightly higher here. So I got a question from a new member, and they want to know exactly where does the fair value gap begin. It's the initial candle in the middle that has a big run that's separated by a candle afterwards that has a high, and the previous candle before it has a low that does not trade inside of the body that one single candle passed through. In other words, I'll say it like this. The high here at 1484 for a fair value gap, this is a bearish fair value gap. This candle here technically would put you in it. Right at this candle's high, that's your institutional order flow entry drill. Like, that's the best case scenario for not missing the move. Okay, all you're going to do is sell it at 1484, and your stop has to be above a recent swing high. Okay, and that would be in here, some measure of a swing high. But now looking just to the left, you have another very close proximity swing high here. You would have to go back further in here to get a stop loss. So what would be a reasonable stop loss? Well, if this is a swing high at 1487, and then swing high is a high, let me take this off here. Swing high is here, lower high, lower high. So the swing high has to be above 1488. Okay. There is no swing high over here. This one, it's lower than this one. You see that? The high is 1488, and the high is 1488.19. So let me double check that. No, this is actually the lower one, only up by 1 pipette, but we have relative equal highs. So you got to be mindful that even though this fair value gap is in here, they could have easily spiked through and grab these equal highs and then move lower. Okay, so your stop loss would have to be above this fair value gap as well. Okay, so this candle's open 1492, well, technically 1493. I would have a stop at 1494, selling at 1485 or 1486 here, which is the low over here, there. So coming up and filling into that is a sell. And then at 10:21 this morning on Twitter, and that's this candle here, we created another fair value gap on a 5-minute time frame. That was the one I actually prompted you all with on Twitter. Now, if you look at the time here, 14:20. The next candle here is 14:25. That means 14:21, which is 10:21 in my local time. You'll see that that's when the tweet was posted. I said gold should not retrace any deeper than here. Ideally, you should see it sell off now. Our downside objective is the 155, so that's the draw on liquidity, and that would be the best case scenario exit. But the range at which I tweeted begins in here. Okay, so if we use the lowest of that candle, 1484, say you sold immediately at the lowest point, not the higher point, the lowest point. Okay, so 1484. Nothing wrong with that. Okay, but now because we went into a lower time frame, we can use these highs to formulate a stop loss placement. In other words, if we want to sell short here, we can put the stop above here and not rely on that 15-minute swing that takes us up to 1494 or 1495 for a stop. We could use this swing high here because all of the institutional order flow elements are here. This candle's low, 1484. This candle's high, 1483, 93 pipettes. That small little passage of price that's only done on a down candle, that's a fair value gap. That's just what you're going to train your eye over and over again. Looking at my examples and looking for charts, you're going to see this pattern here. When price goes up through it here, that's a sell. You'd have a little bit of a heat on going back up to here and riding out to this next candle here, but nonetheless, the very next candle on a 5-minute basis. So if you saw the signal at the same time I was looking at it at 1421, okay, you pull your order up, you get everything ready, yada yada, set your stop loss. You could be getting in on this candle here. Okay, so the high could be, well, 1485 is the price, but the low is 1483. So even if you got at that price, okay, 1483, and the stop has got to be above high here, 1487, so 1489, 1490. It's still less than the 15-minute chart would indicate for a stop. Price has displacement, small little return back, and then expands lower. Right away, we have another fair value gap. So if you missed this one in here, okay, this is what you're looking for. When I tell you certain things and I prompt you certain things either in the videos or if I draw attention to you in Twitter, okay, I want you to immediately go into the 15 and 5-minute charts because this is what you're looking for. Okay, this is the thing that you should be studying. Okay, let me put the rectangle in here. So we have this low and this high right there. That one single candle, that's the fair value gap. It's defined by the low of this candle here and the high of this candle. So all it needs to do is trade back to the high at 1481.5. It does so on the immediate candle here. The high of this candle comes in at 1482. It only went a half of a point, okay? 1/2 a point is all it went. The next candle went up to a high of, oops, right there, 82.15. So again, a little bit past, less than 3/4 of a point drawdown. Entering on this candle, this candle's high here. When price goes back to it, say it opens here and then trades up to that candle's high, that's the entry. That's institutional order flow entry drill. So whenever you hear me refer to that very thing, you're trading with the order flow that we've outlined on the Saturday review and analysis where I said you could trade down to its low end fair value gap, which is around 1455. But I also said that we had liquidity below old lows, which we'll look at in a moment. But the market gives us an opportunity to sell off here, and then it really expands down. So it was really nice to be able to share that publicly with everyone. They have no idea what the setup was, but nonetheless, it was nice to, for them to see that. So I had my peacock feathers out, to be honest with you. My wife was watching me parading. What's your problem, boy? So price goes up into the fair value gap here, and then we have the sell-off. Okay, so it's this candle's high because it has this imbalance here. Normally, we would expect a full closure to be a perfect symmetrical market. But the problem is, if you look at this candle here, let me get it right here. That candle, I guarantee you, all of you have a different high. You won't have 1482.15. You'll have something else. Some of you will have a full closure in that gap. Some of you won't be as far up, but it'll be at that candle's high right there. Okay, that's all we look for. That's the easiest low-hanging fruit entry, trading in the direction that I've already outlined on our analysis. Okay, so let's take a step back and appreciate this a little bit. So here's where I said get ready, expect it to slide lower. And you all knew from Saturday we were looking for lower prices in gold anyway. So at the 38-minute mark on the video, you'll hear me talk about gold, and it would be bullish for the dollar index, which we got. We saw that. I'm going to drop out to a 1 hour chart. Okay, and all of it's happening in here. And I want to go out to a daily. I'll zoom in a little bit here. All right, so here's that low and these relative equal lows here. I said we had a lot of liquidity even below this low here. That low comes in at 1479.5. Okay, so 1479.5. If we go 10 points below that, that would be 1469.5. And we moved down to a low of 1464. And we'll just call that a half, even though it went a little bit lower. So it went an extra 4 points or so, or 5 points below it, which is good. Because if this was a pair, in Forex, we'd have a spread to overcome too. So using this low, going 10 points below it, you easily would have gotten that with spread and everything else included. So if it continues, which it certainly looks like it could, we're looking for this closure here on the fair value gap. Now I mentioned also on Saturday, your model may evolve into just simply using fair value gaps as your entry. Okay, and using opposing fair value gaps. Or it could be your fair value gap as the entry here, and the equal lows is your target, and you're already out. You missed the continuation lower, and that would be fine. The problem with you new students are focusing on really, you want to get every part of the move, and that's not going to happen. You're too new, and there's a lot of things for you to learn. So just be mindful that there's a lot of growth that's necessary, but you don't need a lot of things out of this mentorship to build a very unique, very personal trading model that you'll be able to use every single trading day. Your model, once you hone it and you get it down to a science for you where it makes perfect sense to you, you're going to be really comfortable never deviating from it, and you'll be able to use it on any time frame. You'll be able to look at it and say, okay, I don't care if it's a 15-minute chart in front of me, a 5-minute chart, an hourly chart, a daily chart, 60-minute, I'm sorry, not 60-minute, a 2-hour chart, whatever time frame, it doesn't make a difference. You will know what you're looking for. And for you that just started, you got to see right away, right out the gate, what we do here. The things that I outline, the things I'm looking for. Even if it trades down to where we are now, that's a winning trade. That's a winning idea that pans out. And you can work within that range, as I indicated, with the 5 and 15-minute chart. What it looks like, what it is that you're doing. Now, I understand some of you don't have real-time access. Like, you can't see these things at the moment. It does not matter. Go back in your charts, just like I just showed you here. Annotate them, where the fair value gaps are, how much the market moved against that fair value gap, how long it took for the move to begin and moving away from the fair value gap into an area where targeting would be considered. All those things you want to log and annotate them on your chart in just like small little notes. And then once you have all of your charts for this particular setup, like I mentioned, you want to have a 15-minute chart, a 5-minute chart, and a 1-minute chart. And notice everything that happens between these two price points. Okay, I'm going to drop down to a 5-minute chart, and you're going to be putting your notes on it as well. Everything in here that's salient, what's important. And then in a 1-minute chart. Now you're probably saying, well, what do I need a 1-minute chart for? Because you're going to be able to read the order flow really clear on the 1-minute chart. Let me get this toggle thing off here because it likes to scroll automatically in here. So up in here, 1421, there's 23, 21. Okay, I posted it there. All right, market trades up, comes back down, trades back up, and trades back down. Right in here, last up close candle, the last 3 up close candles, trades up above, short-term high. There's liquidity above that. Yes, even on a 1-minute chart, bearish order block, then sells off. Okay, this is an optimal trade entry, an ideal optimal trade entry because you have a retracement and you have the short-term high in the middle where you can capture buy stop raid, and then it expands lower. On a 1-minute chart, look what happens here, folks. This big candle, that's the one that sticks out. Your eye's going to go right to that one. Okay, that candle. Look what happens later. It trades right up into it, closes it in. What's the low on this candle? 1482.22. What's the high on this candle? 1482.15. We round down. Remember, if we're under the market and we're looking for a particular level, we're going to round down to the nearest 5 or the nearest 0 level. So if this is the low, 1482.22, what's the 0 level? 1482, even. Does it trade at 1482 even? Yes, and 14 little points beyond it. That's how precise you can get. So you can sell it short here and put a stop above here using the 1-minute chart. Market shows displacement, accelerates going lower, consolidation, sells off again, down into a low. This is where we ended up going later on. Then we consolidated, rallied back up. What is this rally right in here? What's it doing? Look over here. You have up close candle, bearish order block, and then you have the imbalance here on the downside. So we have SIBI, sell side imbalance, buy side inefficiency. So in other words, what I'm saying is only one single candle passed between the previous candle's low and the next candle's high. So it needs to only trade back to this old candle's high to get short. It does it here, small little micro move, okay? But your stop has to be above here. So if you sold short here, you're short and you're riding this consolidation out. But if you did not use that when it trades up to here, you're filling in the imbalance here and trading into the order block, this candle here. So the low is 1472 and 82 points. The high comes in at 1471.87, but the imbalance is closed in initially. Watch what happens. Does it raid? Does it go against you? No. It runs right down into a run below this short-term low. This short-term low is 1465, so what would be below that? 1464, 63, 62, 61, 60. It runs to a low of 1464. Just clearing right below this low. And now we've since rallied back, consolidated, and we're retracing. There's an imbalance right in here that I'm personally watching up to this candle's low. Okay, 1476. I'd like to see it stay underneath 1477. Let's put it that, 1477. It can realistically retrace back to here, clear some liquidity here now, and still be bullish. I'm sorry, it would still be bearish, okay, and move for that 1455, 56 level we outlined on the daily chart. Euro dollar. Outlined, should we get some pause and it didn't want to go higher for the dollar index and we allowed euro dollar to want to rally. We had these equal highs and the bearish order block. It didn't need to do that. You can see on Sunday we opened rather unchanged, drifted lower, one more time popped higher, cleared some buy side liquidity, and then had distribution on the downside. I mentioned that if we took this low out, go back and look at the Euro section, 22 minutes and 30 seconds to 23 minutes and 35 seconds of Saturday's video. If we take this low out, it's not bullish. It's going to go lower. It's going to run these equal lows. The equal lows on here, the lowest low comes in at 109.04. 10 pips below that would be 108.94. And then 20 pips below that would be 108.84. And the low comes in on the day so far at 108.84. So again, to script, what was the scenarios? If we open and start to run higher, we're going to clear these area over here for buy side liquidity, hit the bearish order block, and then sell off. But if we break this low right in here, if we break that, then it is straight up bearish, and it's going to run the equal lows here and start working towards. And we had these lows here, 109.25, and if we took 20 pips below that, that would take us down to 109.20 pips. I'm sorry, 20 pips below that would be 109.05. And that's essentially what I have here, this level here. Now, sometimes when I put it on different parts of the line, you can see it shows a different one. But what I'm highlighting there is 109.05. So don't be confused by everywhere I go on this line. It looks like it's a different price. Okay, what I'm actually putting on that line is 109.05. Okay, that's what that level is. And it's simply because it's 20 pips below this here. Now, if the expectation is we're moving lower and we're looking for liquidity below this, how do we get to these lines down here and what makes them important? Well, if this line here is 109.05, okay, 109.05, and we're expecting lower prices, what is it really reaching for? 109.00, the big figure 109. So the protocol is if we're going to reach for a big figure and lower, that means we could move as much as 40 pips. Okay, 40 pips. If you look at this level here, we only show 30. I think that's a reasonable objective because 40 doesn't always happen. That's why this level is here, 108.70. Okay, and then another move lower here, 108.35 is what that level is. So if you look at the entire range here, you can see the midpoint here and here. So 109.05 projected down. This is the next level you would get, what, 108.70. Okay, so if I did a fib and dropped it over here and put the 50 level on that and just kept on pulling the fib down, if the 50 level, watch what I mean by that. Okay, watch, see that line that says equilibrium right in here? It has a little dot. All that is the 50 level on the fib. All I did was drop it down until we get to the point where equilibrium lays right on that there. Okay, and where this is, I copied this line here and put it down here, and that's it's how I do swings on the daily. Now normally it would be just simply a 10, 20, 30 pip run below old lows or above old highs because of intraday charts, but daily charts have a little bit more oomph, if you will. Okay, they can move a lot more. So I used the relative equal lows and then the simple 20 pips below that. That was my first scale. Then I used the unrealized dealing range of this range here, and then go in 30 pips because it could easily do 30 pips below 109 if it expands. We went a little bit low today, but we only going in half of this range from here to here. That's what this gray line is. So I've scaled out all of these ranges based on the assumption of how far we're going to dip below these equal lows. Okay, so 20 pips is reasonable, but then we start getting into 109.05 with expectations of going lower on euro dollar. That means we could potentially break 109. That's our expectation. We want to see that. So if it does, how far do we go? Enter the 30 pip sweep for normal runs above or below a big figure number, 109. Another big figure would be 108. Another figure another big figure would be 1, 0, 10. They're big figure numbers. Okay. Usually the algorithm, when it trades below or above those big round numbers, it wants to usually move around 20 to 30 pips generally. But a real big run on liquidity can see as much as 40 pips. And if it does more than 40 pips, then it's probably more meaningful of a run, and it's not just a reach on liquidity. So I use the unrealized dealing range idea here, and then scaled out, and then set it all up where between this red line and this red line, just like I have this small little trend line segment here, this could be done as equally right in here. So there would be 4 scales. We hit this one here, went through it, so it hits here. So what's the next one to hit? This one. And the next one would be the midpoint between this red line and this red line. And then ultimately reaching down to here, okay? Because it would give us a deep objective below these equal lows if in fact Eurodollar is bearish. So again, I'm keeping these levels on the chart. I'm not going to change anything. I might add another midsection in here just for completeness sake, but not today, because I want to make sure I keep the chart as clean as I can. And that's the business there. Let's drop into a 15-minute time frame and zoom in a little bit. So we had a nice drop down initially, consolidated, and then Judas swing in London, or approaching London. It was early Frankfurt, and then price creates a drop, imbalance. Okay, relative equal highs. All of this in here drops down. This is a fair value gap from here to here. When price traded here, you can be short, targeting the equal lows. Market trades down, slams into them rather easily. Okay, really easy. There's a fair value gap right in here too. See the low and see the high of this candle. 10913 and 6 pipettes. On this candle here, if it trades this high, which it does, it goes above it just by a little bit, you can sell short there. You sell it at the market, and then you would reach for your targets, which would be below here. So 20 pips below these lows would take us down into here. The low comes in on this candle at 10904. So 10884 would be your objective on the downside for 20 pip raid, and 10884 is your low. Okay, beautiful, beautiful, beautiful symmetry. All right, so cables, the last thing on our to-do. I mentioned that I didn't believe that we would see price getting above here. That would be a real problem for being bearish. All of this imbalance in here, we ended up coming back up into hitting that, clearing liquidity here, and then selling off, running equal lows here. I have been very upfront with you all in regards to that, because I'm learning just as well as you are the effects or the lack of any real clarity because of Brexit. Like, I don't know what it would mean if the UK gets out or stays in. I don't know what it means. Okay, so it's very problematic for technical analysis in the pound. So it has to be a really clear, easy setup for me to be involved in it. And otherwise, I'm not going to touch it. But I mentioned I was going to cover this in here. The market on Friday, I mentioned that we were trading down into a breaker relative to the daily chart. And that's exactly what this is right here. And we'll talk about that in a moment when we go back out to a daily chart. But all this big single candle down in 1 15-minute time period, it's a big SIBI. Okay, sell side imbalance, buy side inefficiency. So price went really quick down. When it does that, okay, think of this, and this is how I teach my children. Think of this as a tree, okay? And it's going to be a little silly, but promise you it will make sense if you think about it. This is a tree, okay? Now imagine the monkey goes down the tree really, really quick, and he sees a lion or a leopard after it. Now, a leopard can obviously go up into a tree, but again, just work with me here, okay? He's going to run back up into the tree, okay? And that's basically what you end up seeing. The market wants to go right back up to where it came from. Right up in here, that imbalance. I already know I'm going to get jokes. The monkey in the tree. All right, so there you go. So right here, this is where the last up close candle is. So think of where the monkey lives. Okay, top of the tree. This is where all the bananas, this is all the fruit and all the things that it likes to eat is up here. Okay, it goes down, then it comes back up. Now watch this candle here. This is a bullish order block. Okay, the high is 2284. Market comes down, dips into the order block a little bit deeper, but does not break the bottom of the low. You could be a buyer here. Trades up. Now, normal support resistance, guys, they would expect this high here, draw that out in time, and wait for it to touch it. It never does it. It never does that. Okay, but it does give you a fair value gap. Look what happens in here. This candle's high, 22.96, and this candle's low, 22.97. The market comes down, dips below this candle's low, right there. That's a buy for a run to the top of this range. That's an order flow entry drill. Okay. Same thing here. Old highs, broken should be support. Well, it doesn't work. That stuff does not work. Expands up into the order block, the bearish order block, and closes in all this range. So the premise is we look for areas in the market where all of the price action between one specific price level and another price level, either higher or lower, when it's just one single candle. When it does that, that's the imbalance that your eye is going to be trained to look at. See how he did this run here? This one big candle. After this candle closed, this big run here, it creates all this imbalance. Price comes right back down into, rebalances to here. Okay, yes, it goes a little bit into the candle, but you need to get that low to get the top of that candle's high for your price. So don't be discouraged if you see, 2-3 pips beyond what you expect, because it will need to do that in many cases to offer and overcome the spread. We have a little imbalance here. Okay, price runs up. So what does it do later on? Comes right back down into the order block. That's how you know what order blocks are the one you want to buy that has the imbalance with it. Perfect. Buy it here. What's it going to reach for? Oh, liquidity over here. Runs right up into what? What's it reaching up into? Rejection block, the highest up close candle. The up close price. That's enough. Okay. Price runs all the way up here. At one time, this candle was a full-on bullish green candle. Bold, no wick. It just was a bold butt-ended candle. Trading right up in here and closing in the imbalance here to the last up close candle, which is a bearish order block. Bam, hits it. Runs lower. What is this right here? This high to this low with this one candle going down. This price on this candle, which is the open, 123.05, that price is a fair value gap. So it trades to it 123.07. So it went 2 pips above it here. So you could be a seller there and then target these equal lows right in here. And from there, it sells off. Now, is it a lot of pips? No. Is it 25? Yeah. Is it 20? Yeah. Is it 15 pips? Yeah. Is it 10 pips? Yes. Okay. They're all executable. They're all studies. They're able to be worked with and analyzed and store it in your computer as an example in your study journal. Okay. I'm going to look at this on a 5-minute chart, and then we're pretty much done for today. But your eye should go right to the points of the chart that create one single candle. One single candle, and that's what you're looking for, where it's a range. Okay, where, like right in here. Let me zoom in. My bones are cracking here, man. Old age kicking in. Where are we at? Where was I? I just lost my spot. There it is. This candle here. Now I'm doing this by hindsight because I really wasn't watching cable today. I was looking at gold, and I was on a phone call this morning for a rather lengthy amount of time. So I missed the early portions of New York, but I was able to get on there and pull out gold for you live. But we have the fair value gap here. So you have one single candle that's defined as a fair value gap with this right here. Right there. That's your range. Because this candle's low and this candle's high has not been covered only but one time going up. So the market comes back down and fills it. You could be a buyer, okay? When it fills this entire thing, that's a perfect closure of a fair value gap. But to get this get this price high, or in other words, this candle's high, we got to go a little bit deeper to overcome the spread. That's why you get that overlap a little bit. And that's normal. It's okay. But all you would need to do is buy at this candle's low at 23.03. So at 123.03 plus 3 pip spread, which is about average on most retail brokers, that would be your limit order for entry. And what would you target? You could scale off some here, and you would scale off some here, and then reaching back into that imbalance that's very, very clearly shown on a 5-minute chart, all based on this move here. Okay, it trades down into the last big beefy lowest close down close candle, which is a bullish order block. That's coupled with a fair value gap. So which is better? The fair value gap? Well, if you really want to get in, you get in here. Okay, or you can wait till it trades to this price level, which is the order block. But you're going to many times miss trades if you do this. So have this in your notes. If you're really aiming for the best, choicest entry, be prepared to miss a lot of moves. But if you're using lower time frame charts, it doesn't make a difference because there's a lot of these types of setups all day long. Here's another one. You have another high here, and this candle's low. This small little section right in here is a fair value gap. So I'm just going to borrow this. And this is what you do after you go home from work, after you go home from running your company or whatever you're doing. You're a teacher, or your kids go to bed, and you need to have time to to study. This is what you do. You go through your charts and you find these little tiny little pockets. These are fair value gaps. Market trades down. It goes a little bit past the gap high, or gap low in this case, to overcome the spread. But we also have the same pattern I mentioned earlier. How do you know which order block to buy, Michael? The one that has a fair value gap, the imbalance. So this big beefy down close candle, what's its opening price? 123.16 and 9 pipettes. We're just going to call it 123.17. The high on this candle comes in at 123.17 as well. So we have a fair value gap order block here. So you could use this opening price plus spread. So 123.20, which is institutional. Boom. When this candle happens to go lower, you're buying as it's dropping down. And you'd be long at 123.20 right in here. There. And then price does what? Expands up into the imbalance. You take something off at this old high here, and then see what happens, and it runs up into another imbalance. The fair value gap that's in here gets filled here. Relative equal lows. What's this low? 22.90. So 10 pips below that would be what? 122.80. Low comes in at 22.74. So you get extra pips in your favor to make sure you get 22.80 because of the pip spread. And you would have got it. Fair value gap. Liquidity pool. Okay. It's a really small little fair value gap right in here. It's just like this, folks. It's how it works. Fair value gap in here. Price runs up into it. Sell off here. What are you going to reach for? Same thing. 122.80, which is a relative equal low, and looking for 10, 20, 30 pips below old lows and above old highs. This is what you do. You look for these things. Okay. You have a fair value gap here. Price runs up into it, closes the gap entirely here, but you only need to get above this candle's high. There. Okay. 23.15. We'll call it 23.16, and that's right there. You'd be filled, and you'd have a little bit of heat here. Let's see what the high is on that. High comes in at 23.20. So are you going to be upset with 4 pips drawdown? You going to be upset with that? Because believe me, there's a lot of people in retail that would love just to have just that. And if you're selling here, your stop would be above here. And what do you look for? Well, what's this? This is an old low. What's going to be resting below that? Liquidity. Okay. Keep looking to the left. What do you see? Oh, this is really good because now we have relative equal lows. Now watch what happens. Keep looking back here, and then bam, obvious equal lows. What does it reach for? That right there below those equal lows. So when you're looking for, or looking through your old data in hindsight, do not feel like there's this absence of real time get me in the trade type thing. Okay, because I learned this by doing the very thing I just showed you here today. and you build a huge amount of experience by collecting old setups in hindsight, the way we look for them, not with indicators, not with all the other stuff, but reading price. And you see these examples over and over and over again. Over the course of the week, each night or each day when you have the opportunity to go through your hindsight data, obviously if you have a real-time opportunity to sit and watch it real time, then you want to do that. But you don't need to do that initially. You want to be able to look for them in hindsight and find them in price action. Annotate your charts like you see here and be as detailed as you want to be. Okay, I mean, this is your study journal. You want to be pouring yourself into this because this is absolutely going to be the best trading book that you've ever read, because it's going to be in your own handwriting, in your own thought process, and you're going to resonate, or the setups themselves will resonate more with you because you have intimately studied them. You've spent a lot of time with them. And over the course of a week, it wouldn't be surprising to have 20, 30 different examples that you've collected. And then you want to spend the weekend reviewing them and how they matched up with the day after and the day after and where it lies within the full weekly range. Every one of these have a little part, if you will. They're like a little cog or a gear in the larger machine that creates that weekly range. And you want to be able to study how they all integrate with one another. And believe me, it doesn't make sense what I'm saying until you start doing it. That's the work that's involved. Everybody wants to just watch my videos and think it's going to be easy because you watch the video. This is what you do. You go into the chart and you find the setups over and over and over again. Because what you're doing is you're teaching yourself pattern recognition. It activates your reticular activating system, and then what you end up seeing is the things that you filtered in your study, your eye will go right to it. These little single candles that have one single pass higher or lower, that's your fair value gap. If you see that, it makes the order blocks stand out better. Because all the things that everybody sees in my free tutorials, oh, it's all about order blocks. It's really supply and demand. No, it's not. It's not. There's other factors that go into this, okay? And just simply because it's a down closed candle doesn't make it a bullish order block. So I've covered a lot in this video today. Hopefully you got something from it. Watch it a couple times, okay? But really go into your charts and annotate and collect these setups throughout the entire week. I promise you, if you do it for 30 days, just do it for 4 weeks, pick a pair, one or two pairs, but really specifically aim on one, and you will see the plethora of examples of trades that are there every single week. There's multiple setups every single week, and they're right out of your month 1 content, low resistance liquidity runs. Okay, so until I talk to you on Wednesday, I'm sure I'll be talking to you tomorrow on Twitter, and probably in a couple minutes when this video is uploaded, I'll still probably put some things on Twitter. But until I talk to you on Wednesday with the midweek review, I wish good luck, good trading. Be careful, and remember, it's non-farm payroll week. Get all your business done by Wednesday, New York Open, and then we're off for the rest of the week in terms of trading.